This Wednesday, one single report could change everything for gold and silver. It's called the CPI report, and if you don't know what that means yet, you will by the end of this video, because this Wednesday's number could be the most important turning point precious metals have seen all year. Every trader, every investor, every analyst on Wall Street is watching the same calendar right now, and they're all circling the same date, the same day, the same moment. Wednesday morning, when the U.S. Consumer Price Index report drops. This is not just another piece of economic data. This is the report that tells the Federal Reserve whether it can ease up or whether it needs to push harder. And whatever the Fed decides to do next, gold and silver will react immediately. So if you hold precious metals, if you're thinking about buying, or if you're just trying to understand what's happening in the market right now, you need to understand what this Wednesday means. Let's start from the very beginning, because this story deserves to be told properly. To understand why Wednesday's CPI is such a big deal, you first need to understand what CPI actually is. CPI stands for Consumer Price Index. In the simplest possible terms, it measures how much everyday things cost: groceries, rent, gasoline, clothing, medical care. The government tracks the prices of hundreds of these items every single month, and then it compares those prices to what they were a year ago. If prices are higher than last year, that's inflation. If prices are much higher, that's high inflation. And high inflation is something the Federal Reserve takes very seriously. Now, why does the Fed care so much about inflation? Because the Fed has two main jobs: keep inflation low and stable, and keep Americans employed. When inflation gets too high, the Fed's primary tool is to raise interest rates. Higher interest rates make borrowing more expensive. More expensive borrowing means businesses slow down their spending, consumers cut back on purchases, and eventually, the economy cools off, and inflation comes down. That's the theory, and it generally works. But here's where gold and silver enter the picture. When the Fed raises interest rates, the US dollar tends to get stronger. A stronger dollar makes gold and silver more expensive for buyers around the world. Less demand means lower prices for precious metals. On the flip side, when inflation is high and the Fed is forced to hold rates elevated, investors start worrying about the long-term value of their money, and gold has been the world's answer to that worry for thousands of years. So CPI data affects gold and silver from multiple angles at the same time, and that's why this Wednesday is so important. Now let's talk about where we actually are right now in 2026, because the context here is everything. Gold started this year on an absolute tear. It crossed $5,000 per ounce for the first time ever back in January. Silver broke above $100, also for the first time in history. These were historic moments that made headlines around the world. But since those highs, both metals have pulled back significantly. Gold is now trading around $4,300 to $4,500 per ounce. Silver has fallen even harder, trading near $69 to $70. That is a substantial correction from those record levels, and the main reason for that correction is the Federal Reserve, or more specifically, what the market thinks the Fed is going to do next. Here's what happened. Earlier this year, most people expected the Fed to start cutting interest rates in 2026. The idea was that inflation had cooled enough, the economy was slowing, and rate cuts were just around the corner. Gold and silver loved that story, and they priced it in aggressively. But then something changed. The May jobs report came out, and it completely shocked the market. 172,000 new jobs were created. Analysts had expected around 85,000. That's double the expectation. A jobs market that strong tells the Fed one thing very clearly. The economy does not need help right now. And if the economy doesn't need help, the Fed has no reason to cut rates. In fact, some traders started wondering if the Fed might actually raise rates again. That fear sent gold and silver sharply lower, and now the entire precious metals market is holding its breath, waiting for Wednesday, waiting for the CPI number, because that number will either confirm those fears or put them to rest. Let's think about what the two possible outcomes look like. Scenario 1, CPI comes in lower than expected. This is the scenario that gold and silver bulls are hoping and praying for. If inflation has cooled more than the market anticipated, it changes everything. Suddenly, the Fed has room to cut rates. The aggressive rate hike fears fade away. The dollar could weaken, and gold and silver, which have been sitting under pressure, could spring back to life very quickly. A lower than expected CPI on Wednesday could be the catalyst that sends gold back toward 4,700, 4,800, maybe even higher. Silver, which tends to move more dramatically than gold, could see an even sharper percentage recovery. This is the turning point scenario that many precious metals investors are hoping Wednesday delivers. Scenario 2, CPI comes in higher than expected. This is the scenario that precious metals bulls fear. If inflation is still running hot, still above the Fed's 2% target, then the Fed's hands are tied. They cannot cut rates if inflation is still elevated, and the market might start fully pricing in not just a pause, but an actual rate hike by the end of the year. That would put serious additional downward pressure on gold and silver. Gold could test 4,200, 4,100, potentially lower. Silver could break below the $69 level that traders have been watching so closely. This would be the scenario that prolongs the correction and pushes the next big move in precious metals further into the future. Now here's the thing about these two scenarios. Neither one is certain. The CPI report is one of the most unpredictable pieces of economic data every single month. It can surprise to the upside, it can surprise to the downside. And even when it comes in exactly as expected, the market can react in completely unexpected ways. That unpredictability is exactly what makes Wednesday so fascinating and so important to understand before it happens. Let's talk about what inflation actually looks like in America right now, because understanding the backdrop helps you interpret whatever number comes out on Wednesday. Inflation in 2026 has been stubborn. After the dramatic spike of 2022 and 2023, and the gradual cooling of 2024 and 2025, many people hoped inflation was finally behind us. But several factors have kept it from fully coming down to the Fed's 2% target. Energy prices have been one of the biggest contributors. The conflict involving the United States and Iran has kept oil prices elevated. Higher oil prices flow through into almost everything else in the economy: transportation costs, manufacturing costs, food production costs. When oil is expensive, inflation tends to stay elevated across the board. Housing costs have also remained stubbornly high. Rent in many American cities is still significantly above pre-pandemic levels, and housing makes up a very large portion of the CPI calculation. So even if food prices stabilize, even if some goods get cheaper, high energy and high housing can keep the overall CPI number elevated. This is the environment that Wednesday's report is being released into, and it's why even professional economists find it genuinely difficult to predict what the number will be. Now let's talk about the Federal Reserve itself, because understanding the Fed is crucial to understanding gold and silver in 2026. The Federal Reserve, under its current leadership, has made it very clear: getting inflation back to 2% is the priority. They will not sacrifice that goal just because markets want lower rates. The Fed has seen what happens when central banks ease too early. Inflation can come roaring back, and that second wave is always harder to fight than the first. So the Fed is being extremely careful. They're watching every piece of data: jobs numbers, retail sales, housing data, and most importantly, CPI. The CPI report is the single most important data point the Fed watches when making rate decisions. And the CPI report that drops this Wednesday will directly influence what the Fed says at its next meeting. Think about it this way: if CPI comes in cool, the Fed might start discussing when rate cuts could begin. Even the hint of that discussion would send gold and silver sharply higher. If CPI comes in hot, the Fed might start discussing whether another rate hike is necessary. Even the hint of that discussion would send gold and silver sharply lower. Wednesday's report is essentially a direct message to the Federal Reserve. And gold and silver traders around the world are going to be reading that message at exactly the same moment. This is what makes Wednesday a genuine turning point, not just for this week, but potentially for the next several months of precious metals direction. Let's now talk about the gold market specifically and what Wednesday means for it. Gold has had an extraordinary 2026 so far. Even after the correction from $5,000 down to the $4,300 to $4,500 range, gold is still up approximately 30% compared to 1 year ago. That kind of performance puts gold among the best performing assets of any kind in the world this year. And the case for gold going higher over the medium and long term remains extremely strong. Major financial institutions are not abandoning their bullish gold targets. Goldman Sachs maintains a target of $5,400 by year-end. JP Morgan sees gold potentially reaching $6,000. UBS has a year-end target of $5,900. These are serious institutions with serious research teams, and they all believe that the factors driving gold higher are structural, not temporary. Central banks around the world continue to buy gold in enormous quantities. Countries like China, India, Poland, and Turkey have been adding to their gold reserves month after month. This buying is not driven by short-term price speculation. It's driven by a desire to hold less US dollars in reserve, to diversify away from dollar dependence. And gold is the world's most trusted alternative to the dollar. That structural central bank demand creates a very powerful floor under the gold price. Even during corrections like this one, the central bank buyers tend to step in, and that helps prevent gold from falling too far. But the short-term direction, especially for the next few weeks, genuinely depends on Wednesday. A soft CPI report could be the spark that reignites gold's rally. A hot CPI report could extend the consolidation, or push gold lower before the next leg up. Now let's talk about silver, because silver's situation is even more interesting heading into Wednesday. Silver has fallen dramatically from its January highs above $100. It's now trading around $69 to $70. That is a more than 40% decline from the peak. For silver investors, that has been a painful experience. But here's the thing about silver that makes it uniquely fascinating in this environment. Silver has two stories running at the same time. There's the monetary story, which is similar to gold. Silver as a safe haven, as a store of value, as protection against inflation and dollar weakness. Under this story, silver moves with gold, and Wednesday's CPI matters enormously. But there's also the industrial story. Silver is not just a precious metal. It is the most electrically conductive metal on Earth. And in 2026, the world's hunger for electricity is growing faster than ever. Solar panels use silver, and solar installation is breaking records globally. Electric vehicles use silver, and EV sales continue to climb every quarter. Advanced semiconductors, medical devices, defense systems, all of these industries are competing for the same silver supply. And here's the critical point. Silver supply has not kept up with this demand. Global silver mining production has been relatively flat for years. New mines take a decade or more to develop and bring into production, so you have rapidly growing demand on one side and constrained supply on the other. That combination is what drives prices structurally higher over time. And it means that even if Wednesday's CPI is disappointing in the short term, the long-term case for silver remains one of the most compelling in any commodity market. HSBC recently raised its silver forecast significantly. Bank of America has said silver deserves a core portfolio role in 2026, and the gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is still sitting at historically elevated levels. Historically, when that ratio is high, silver is considered undervalued relative to gold, and eventually silver tends to close that gap, sometimes very quickly and very dramatically. So heading into Wednesday, silver investors are watching two things simultaneously: the CPI number for its impact on Fed policy and precious metals broadly, and the $69 support level that we talked about in detail. If CPI comes in cool, silver could bounce hard from that level. If CPI comes in hot, silver could break below 69 and find a new lower range. Wednesday resolves that question. Now let's talk about how ordinary investors should think about this moment, because it's easy to get caught up in the short-term drama of a single report and lose sight of the bigger picture. The truth is, trying to trade around a single CPI number is extremely difficult. Even professional traders with years of experience and sophisticated tools get it wrong regularly. The market can react in ways that seem completely counterintuitive. Sometimes a higher than expected inflation number actually sends gold higher, because investors decide that inflation itself is the bigger long-term threat, and they buy gold as protection. Sometimes a lower than expected inflation number sends gold lower, because investors decide the economy is weakening, and they sell everything. Markets are complex, human, and sometimes irrational in the short term. That's why the most successful precious metals investors focus on the long-term picture. They use short-term volatility around events like Wednesday's CPI as opportunities, not as reasons to panic. If you already hold gold or silver, Wednesday is a time to stay informed, not to overreact. If CPI causes a sharp drop, ask yourself whether the long-term case for precious metals has actually changed. In most scenarios, the answer will be no. Central banks will still be buying gold. Industrial demand for silver will still be growing. The U.S. national debt will still be climbing. And the dollar's long-term purchasing power will still be under pressure. None of those things change because of one CPI number. If you're considering entering the precious metals market for the first time, Wednesday actually represents an interesting opportunity regardless of which way it goes. If CPI comes in cool and prices rally, you get confirmation that the trend is turning. If CPI comes in hot and prices dip, you potentially get a better entry point. The key is not to try to call the exact bottom, but to build a position over time. Dollar cost averaging, buying a fixed dollar amount regularly regardless of price, is the strategy that most financial advisors recommend for volatile assets like silver and gold. It removes the emotional pressure of trying to time the market perfectly, and it ensures you are building your position steadily over time. As we get closer to Wednesday morning, here are the specific things to watch. Watch the actual CPI number versus the consensus forecast. It's not just about whether inflation went up or down, it's about whether it came in above or below what the market was expecting. A number that meets expectations can actually cause very little movement. The big moves come from big surprises in either direction. Watch the Fed's reaction and statements in the hours after the CPI release. Fed officials sometimes give interviews or make statements on the same day as major data releases. Their tone and language will tell you a great deal about what the Fed is actually thinking. Watch gold's initial reaction and then its reaction 1 hour later. The first 15 minutes after a major data release can be chaotic and misleading. The move that holds after the first hour, that's usually the more meaningful signal. And watch the $69 level on silver. If silver can hold above 69 even on a hot CPI number, that would be a sign of genuine underlying strength. If silver breaks below 69 on a cool CPI number, that would be a very unusual and bearish signal. These are the things that will tell you the real story of what Wednesday means for precious metals. Let's take a step back now and look at the full landscape. Because as important as Wednesday is, it exists within a much larger story. The story of gold and silver in 2026 is ultimately a story about trust. Trust in currencies, trust in governments, trust in financial systems. When that trust is high, investors feel comfortable holding paper assets, stocks, bonds, cash. When that trust erodes, they move toward real assets, physical things, gold and silver. And right now, in 2026, trust in traditional financial systems is being tested in ways that haven't been seen in a long time. America's national debt has crossed levels that previous generations would have considered unthinkable. The U.S. credit rating was recently downgraded by Moody's, eliminating the country's last perfect credit score. Geopolitical tensions are running high on multiple fronts. And the Federal Reserve itself is going through a period of significant change and uncertainty. These are not short-term problems. These are structural forces that will take years to fully play out. And gold and silver, as they have for thousands of years, are positioned as the ultimate insurance policy against exactly these kinds of risks. That doesn't mean prices go straight up. It doesn't mean there won't be painful corrections along the way. Wednesday could bring one of those corrections, or it could bring the spark that ends this one. But what it does mean is that the fundamental case for holding precious metals in your portfolio is as strong today as it has been at any point in recent history. The investors who will look back on 2026 with satisfaction are the ones who used moments like this Wednesday not to panic, not to make reckless bets, but to stay informed, stay patient, and stay positioned in assets that have protected wealth through centuries of uncertainty. Wednesday is coming. The CPI number will drop, gold and silver will react, and the next chapter of this precious metal story will begin to write itself. Make sure you're watching, make sure you understand what the number means, and make sure you're positioned for whatever comes next, because in the gold and silver market right now, every single data point matters. And this Wednesday, the most important data point of the month is about to arrive.